identified in the US almost 70 years ago. And when he studied the entire markets in terms of the cycles that the market went through, he identified certain important aspects of growth stocks. And generally, I think if you probably place these aspects in a particular market cycle or a market condition that we are probably in, it easily helps us to identify better run companies where the fundamentals are extremely strong and robust. And at the same time, I think technically, how do you enter these stocks? So I think it's more a system in which a large emphasis has obviously been placed in terms of strong fundamentals of that company, how that earnings pedigree is compared to its peers and competitors. How does that company stroke sector stack up in any market cycle that we are probably going to discuss? And in that market cycle itself, how the leaders within these sectors are expected to perform. And last but not the least, if all factors from a fundamental perspective are in place for that particular sector, for that particular stock under consideration, whether the technicals and the technical entry point, whether you should enter now or take some time out because of the technical nature of what that stock is going through in that particular market cycle, I think it becomes very, very easy in terms of having a higher amount of risk reward and the probability in terms of having more profitable trades and the return on invested capital actually improving over a longer period of time. So I think it's a fact-based system developed by our IBD founder and chairman, William O'Neill. So as I was discussing, it basically encompasses three broad elements. So what CanSlim does is, as I spoke about the first two, the fundamentals and the technicals, I think, are extremely important. A large emphasis, obviously, in terms of fundamentals, because if fundamentals are poor and if technicals remain sound, I think it does not make sense because there might be some false amount of breakdowns that stock can exhibit because you're purely playing it on a technical perspective. But if the fundamentals are absolutely in place based on earnings, based in terms of their top line growth, based in terms of their superior margin profile compared to its peers. And obviously, I think what happens in terms of the return ratios, specifically the return on equity, return on investment capital, if these ratios are outstanding and improving every passing quarter and every preceding year as well, you've obviously got a winner on hands as far as the fundamentals are concerned. So technicals will aid us in terms of having an appropriate entry point for these stocks under consideration. And the third part on what the entire emphasis of today's webinar is going to be is determining in what part of the market cycle we are in. And therefore, I think the market direction concept using distribution days, using follow-through days to identify market tops and market bottoms. We will discuss that in the next few slides, become extremely pertinent. And this has actually worked. So I'd like to give you the live example on how this has worked in the previous year's fall that we saw in March 20. Because of the black swan COVID event that the entire market and risk on equity asset classes across the globe witnessed. Now, what does CanSlim encompass, right? So I was talking about fundamentals and technicals. So I think a lot of these elements are captured in CANSLI. And let's leave the market direction to the third part in terms of the market direction that we'll discuss, which is probably the most important part in terms of determining how aggressively you should be positioning yourself as far as the markets are concerned. So I think the first two elements of CanSlim, the C and the A part, solely rest upon how earnings are supposed to grow. And the reason behind this is if earnings are growing at a very, very fast pace or at a compounded pace with the consistency that one looks at, you probably got winners on your hand. Why am I saying that? Because if you're probably looking at the last preceding 2 quarters and also comparing the quarter-on-quarter growth on a year-on-year basis in the C part, and if that earning sequence is growing 25%, you're probably expected to see that the company is probably doing some things right, which is drawing that strong earnings momentum. Now, there might be some questions that might get raised. Maybe there is some abrupt event that is happening with the company. Or when you saw a couple of years back in September 19, when Nirmala Sitharaman actually did tax cuts, right? All of us remember that when she brought down corporate tax significantly and the market had a Nirmala candle on that day, which got repeated apparently in that budget candle itself. But the market actually moved around 4 to 4.5% in a single day that we probably witnessed. Why was that happening? Because of lower tax cuts, obviously, I think the profitability of most companies in most sectors would have done well. And generally, I think the markets reacted. So there might be an essence of abrupt earnings that might come through for a couple of quarters. Maybe because there is something which has happened in terms of anti-dumping duties, as an example, which probably abates the growth for that sector, certain stocks within those sectors compared to the other sectors as well. Or for a quarter or two, I think some sectors do exceptionally well in terms of their earnings pedigree, but I think the rest of the quarters they probably fall off. So I think typically commodity cycles work in this fashion, where I think a couple of quarters are extremely good and lucrative as demand supply dynamics change in their favor, as pricing changes in their favor, which reflects very positively in terms of strong earnings momentum on a couple of quarters. But then it probably stagnates and comes off unless there is a change in the cycle totally that we are probably looking at, where the demand is expected to remain strong, and simple economic theory where supply dynamics probably do not alter the demand dynamics, and the pricing and the pricing probably stays with the company, which probably means that the operating leverage gets driven right and drilled down right to the bottom line as well. However, I think if the quarterly earnings are growing along with the annualized earnings, and if the annualized earnings are growing for 25% or more in the past 3 to 5 years, you can then correlate if quarterly earnings are moving and improving at a good clip, along with annualized earnings moving at a good clip. You can actually then map out and weed off a lot of companies within the broader markets itself, because very few companies will show this kind of earnings momentum consistently over 3 years and repeat that in the preceding few quarters as well. So you've definitely got a winner on hands when it comes to such elements that you probably filtered yourself through. Now, how do earnings actually compound, right? Because it's going to be a top-down effect. It's like a funnel, right? Whatever you put inside the funnel and whatever gets filtered through. But I think the funnel should also have that much amount of growth for the bottom line to increase significantly. So when you're probably filtering through the entire stocks, which obviously get filtered through very effectively through the canceling methodology, the top line growth also improves at a very fast clip in the preceding few quarters and the preceding few 3 to 5 years as well. So the top line growth remains extremely robust, extremely strong. That gets translated because of better EBITDA margins. Now, what are EBITDA margins? If you probably look at your top line or your sales growth, and you take into account all the costs that a particular company is incurring for these periodicities of time, whatever gets left in terms of their operating performance, how are they able to manage costs vis-a-vis the sales that they've done? And that is how EBITDA margins or operating margins are calculated. So the operating margins are superior compared to its peers, are superior compared to the other sectors as well. And that itself drives stronger bottom line growth because of strong top line outperformance, strong EBITDA or operating performance translating into better and robust bottom line growth. You've obviously got winners on your hand, which the C&A part reflects. Because I think there's not too much dilution that happens in terms of the shareholding pattern itself. The return on equity, which is a very efficient tool on how shareholders will expect their money to come back to them. If it is at least 17%, and what we've observed on a compounded basis for all these companies that we have been back testing, and currently observing through the system itself, a majority of the companies, when the ROEs or the ROICs also exceed 17.5 odd percent, because of all these strong underlyings at play, you've definitely got winners at hand when it comes to the fundamental profile of screening from an earnings perspective. And we all know, right, that the markets are slave to earnings. So I think if these stocks are doing these things right, it's a top-down effect happening right up to the bottom line and in the efficiency ratios as well, with ROEs and ROICs staying in excess of 17.5%. Commodity cycle, as I said, for a few companies, return on capital employed might be a little bit lesser. And the logic is very simple, because they have to pump in a lot of capital in terms of fixed assets. Now, since they're pumping in a lot of capital, they also need to get a lot of debt, because I think when the financing happens for all these assets that are bought on stream, happens with a mix of equity and debt. So the kind of leverage that they take on, debt that they take on their balance sheet, if such commodity companies are able to manage it well, and a few companies, trust you me, have done that exceedingly well, whether they are metal companies, capital equipment companies, cement companies, but the leverage is not too high. They've got leadership position in terms of capacities, And as the cycle turns in favor of these commodity-driven companies and the commodity-driven cycle comes to the fore, these leaders within these segments also exhibit strong earnings momentum and strong price momentum as well. So I think important aspects to be kept in mind. The end part relates to the new products, services, anything new that the company is bringing forth, a new change in management, which can create huge moats for that company under consideration. An example that we often give out, and again, I think the compliance is very, very clear here, right? So I think these are examples just from an education perspective. A few years back, when Bata launched its line, right, in terms of footwear, it did a humongous amount of advertisement for getting their new products, new services. It was an absolute revamp that they did for their stores. An entire new product line that came from men's footwear, kids footwear. There were a lot of women's accessories that played out as well, and larger new formatted stores as well. So I think that newness factor, as that starts coming through, and as the street starts identifying that, if they're going to create a moat and a disruption for the entire industry. So the entire footwear industry as it stands, or as it stood even 3 years back, very few players have leadership position in largely unorganized, even at this point of time. So as new players come in, I think there is huge market share gains to be done. But I think the organized players will obviously have a lot of market share gains over a lot of unorganized players, which will not be able to carry on both in terms of pricing and servicing as well. So I think the new factor or the newness factor which comes through becomes extremely important, and that also becomes an important distinguishing and differentiating factor for a lot of companies and leaders within a lot of sectors to actually get these new modes into play. When you come to the S factor, which is the supply and demand dynamics, you're probably looking at the technical aspect at this point of time. So when I spoke about your entry points and what we do in part 2 of this webinar, look at the basics of certain chart patterns and look at how the entry points are envisaged as per the O'Neill methodology. I think there's always going to be some element of demand and supply. Institutions, which is also the I part that I've covered in CAN-SLIM, are important drivers of not just stocks under consideration, but the kind of demand that comes to the stock as well. So if the stock is performing consistently and management commentary is indicating or hinting towards even better quarters going ahead, I think the strong demand that will come through, and as the stock breaks out of its base formation or certain technical formations that it is developing, I think institutions are going to drive that. And as demand comes back strongly, it will absorb all the supply that is probably coming through. And that entry point that probably comes through on appropriate base patterns being created is the technical entry point, because the fundamentals for these companies remain extremely, extremely robust, as we've discussed in the C, A, and N part, encompassing most facets of the fundamental profile that we are probably looking at from a market perspective. Right? And therefore, we come to the concept of leader and laggards as well, the L part, right? And the L part remains extremely important as well, because we're concentrating on leaders and not laggards. So all of us are aware, in any given sector, a few companies will have a leadership position, and a few companies within that same sector itself will be laggards within those same sector as well. You look at footwear that I was just talking about, right? Leaving the first two players, you're probably looking at the other players actually being laggards in terms of not having consistent top line growth, margins being very inconsistent as well, and the bottom line growth remaining very, very patchy because of inconsistent top line and margin performance as well. Couple that up with an excessive amount of leverage or debt onto their books and balance sheet does not support that. And institutional ownership in all these stocks remain extremely, extremely weak. So I think if you have to analyze a lot of aspects put together, top line growth, margin superiority, bottom line growth in terms of CA earnings growth look extremely strong. An N portion which probably needs to be analyzed in greater detail, whether they're getting anything into the market which can be a disruptive factor, whether they are leaders in their spaces as well, which is a clear exhibition in terms of all these factors on how quarterly earnings, annualized earnings are growing, the dividends that they are paying, whether there are the promoter pledges into the market as well, and whether there are no corporate governance issues as well. And last but not the least, how institutional ownership actually is increasing quarter after quarter, staying put, giving in demand for that stock and sector under consideration, which will give us winners very, very clear.